Good morning. It is Friday, November 16th, a few days before Thanksgiving. 6 days before Thanksgiving, Turkey Day. Packers lost last night because the offensive line can't block, but everybody wants to fire the coach. I say let's get a couple offensive linemen and then see how much we like the coach. Aaron Rodgers can't throw the ball to all those playmakers from his back. I am playing in the Mid-States Poker Tournament main event, Wisconsin Poker Championship later today. If you're in town, come on out to Potawatomi Casino. They love when I say that. And let's talk about oil opportunities. Okay, that's what we're really going to talk about. So, go ahead and fire up your questions. All the silly things that you've heard about oil, about the gluts and the surpluses and the falling demand. Tell me all about it. Tell me about the things the traders have told you. What have the traders told you is happening? Come on. It's out there. I'm going to show you something. Negative gamma. We're going to talk about negative gamma today. Want to talk about negative gamma? Should be an article. Yep. There it is. Number 1 in the news box. Why did oil really come down? Why? Come on. Yes. Amazed by how the world is going to be awash in oil next year. Awash in oil. Because the Saudi Arabians love the idea of oil in the 50s. They love it. Right? The Saudi Arabians love the idea of oil in the 50s. They're not going to do anything about it. Except, I know, Sandeep, I know. Except cut exports to the United States by hundreds of thousands of dollars. Hundreds of thousands of barrels, Hundreds of thousands of barrels per day. And they're going to have an oil output cut next year of around 1 million to 1.5 million barrels. So let's take a look at the EIA. Hello, EIA. Now, the IEA is different than the EIA. EIA, EIO, right? No, that's not right. EIA. So let's look at the short-term energy outlook. Hey, short-term energy outlook. See, that stuff just pops up. Ooh, look at this neat chart. Ooh. Can you see that neat chart? Let's make it bigger. I can still do that. I can press buttons. Even if my security software didn't like my webinar software. All right. Let's take a look at this. What does this mean? Confidence intervals. Where will the futures price go for oil? Oh, no. Stay there. Should I save this one? I'll save the image. Oil confidence. All right, I'll open it up nice and big. There you go. So, we're trying to figure out where the balance in oil is between supply and demand, right? We know that the demand for oil is going to increase around 1 million barrels per day next year. The IEA, International Energy Agency, administration, whoever they are, I think they're agency, is saying that oil demand will increase by 1.3 million barrels a day next year. That is down from 1.6 to 1.4, which were the earlier forecasts. Why? Because everybody thinks the Trump trade is going to slow down the economy. So the oil demand growth forecasts are already lowered, presuming Trump's going to screw up trade. All right, so Trump is already factored in. What does that mean? What is the potential for surprise? Is the potential for surprise negative or positive? Somebody in the chat box? If they've already factored in Trump screwing up trade, that's right. That means that the potential for demand is to increase above 1.3 million barrels back towards that original forecast of 1.6 million barrels per day extra. Okay? So we have the potential for positive surprises in the oil market. The negative surprises are pretty much all out of the way, and the traders have ridden those as hard as they could down. And this week, they hit capitulation. They got all their futures rebalanced because there was a situation where the falling price caused some of the banks to have to redo their books. It's really what it came down to, is they were getting into a position where they were taking too much risk with the falling price of oil. In order to fix that, they had to drive it down just a little bit more because they had to sell options and redo their futures, this negative gamma event. So you ought to read this article from Bloomberg. I strongly suggest that everybody pay for Bloomberg. See, I actually pay for it. They don't want to log me in right now. Maybe they do. Yeah. Is that password? Yay, welcome research. So in any case, in this article they discuss that we really just had a rebalancing of oil risk because the volatility shot up. The traders caused this event. The banks are like, we have to fix it. And now it's fixed. And you see what's happening with oil today. Bam. Oil. Up almost 2%. It was up 2.5% earlier. Okay. So when we talked about the oil traders providing an easy opportunity to go along, somebody knew what they were talking about. Okay. Now, what should we be doing about it? All right, what should we be doing about it? Let's go straight to the trade. Straight to the trade. If you are aggressive and you actually want to invest in oil versus oil stocks, and we'll get to oil stocks because I think there's some great opportunities out there. Okay. You saw every time this happens, right? So now that we've had this, what's next? Probably this. Somebody on our chat board noted that the rebound off of bottoms like this is usually at least 15%. But sometimes those rebounds are even higher. Sometimes to the tune of 30 or 40 or 50%. And I'm pretty sure that's what we're going to get this time. Let's talk about some of the reasons. Okay, let's talk about why oil is going to jerk up. Here's the reasons why you're not going to see oil stay down in the 50s, probably not even the 60s. I would imagine it'll be back to the 70s and pushing 80 by summer. And there's a number of reasons why. And the Fed is part of this equation. But we'll get to them last because it's something that nobody's talking about. And I'm going to start talking about stagflation soon in the next several months. I've hinted at it over the last year. If the Fed keeps raising interest rates, some of you folks who remember stagflation from the late 70s, you're going to get a redo. And I hope that I'm wrong about the Fed being stupid, but all signs point to me being right. So we'll see. So let's just talk about oil in general. Let's get rid of some of these notions that somehow the oil is just suddenly a wash. Okay, first things first. Not Permian Basin, but shale in general. In general, the shale producers have gone to the cheapest, easy to get oil before they go to the hard to get oil, right? So they've done what's called high grading. They've even high graded offshore, right? They've gone to the places in the Gulf of Mexico that are the cheapest and easiest to get to. And now they're moving out to deeper water, trying to find oil, and it gets more expensive every time. Then you hear these phrases like break-evens on our oil of $40 a barrel. Let me remind you, that's after all the capital expenditures have been paid for. So if it costs $1 billion to do an offshore oil project, and that would be a big one at this point. A lot of them are only costing $300-400 million now. Let's say $300 million. And you take that first barrel of oil out. What's your break even on the first barrel of oil? $300 million. It's not until you've made 300 million barrels, $300 million net, that you've paid for that rig. So let's suppose oil is trading at $60 a barrel. Bring out the handy dandy calculator and say, okay, I need $300 million. I'd buy a $20 profit margin. Because let's say our hypothetical is $40 break even. So at $60 barrel oil, divided by 20, I need to pull out 15 million barrels of oil before I pay for that rig. How long do you think that takes? Well, the answer is between 5 and 10 years, depending on the rig. So let's ask a question. How many deepwater rigs are going to be drilled, given that there's a 5 to 10 year payback before you're starting to become profitable? The answer is not very many. So we go to, who do we go to? Deepwater oil, Rystad. Where's my handy dandy charts? Rystad. Right, it's Rystad that does this. No. News and events. Yeah, see, and that was actually a headline from a year ago, right? And we didn't get it. They said we were going to get it, didn't get it. But Rystad, rigs, day rates, right? There we go. If somebody knows where that chart is, I used to have it bookmarked. Anyway, Rystad keeps track of the day rates for rigs. And this looks pretty recent. They should have a link out. Rig analytics. Oh, this is the one I didn't prepare. Sorry about that. Anyway, day rates for rigs have not been going up very fast. And that's because the demand just isn't there. And the demand just isn't there because it takes so long to break even. If somebody finds that chart, I'll throw a link in the chat and we'll talk about it again for a second. In any case, here is world oil production and world oil consumption. And you see that the EIA, President Trump's EIA, suddenly adjusted things so that it would look like there was a surplus of oil. Not going to happen, friends. Not going to happen. These two lines are going to be right on top of each other. Why? Because I've talked about that before in this one. Is this where I put out my chart that everybody hated? Yes. So this is the reality for oil demand. Supply and demand are going to be roughly even through the middle to the end of the decade. Sometime around 2030, could be 2026, could be 2034, 25, 35, right in that range, right in here somewhere. You're going to have the last bastion of internal combustion engine vehicles being sold. And then demand's going to gradually fall off for a decade. And it's going to go from about 100, this should be up around 112, 110 million barrels per day is what we'll probably get to. We're at about 101 right now. Right, we're at about 101 right now. then demand falls off. And then could this curve be moved a little bit out this way? Sure. Could this curve be moved out a little bit this way? Absolutely. You know, Tony Seba, the Stanford professor, I believe he is saying that we fall off, you know, this curve is way over here, like 2022. OPEC and Exxon and Chevron are saying, oh, it's way over here, 2040. So if the left-wing environmentalist, sustainable energy, change the world guys are over here, that's what little dogs do. They make noise. And the OPEC, we got to sell a lot of oil, and Exxon, Chevron, we got to sell a lot of oil guys are over here. Where's the reality? It's in here somewhere, right? So in the next several years, what are we going to have? We're going to have the United States increase oil demand, but here's what we have to understand. About 1/3 of the oil companies out there now are able to produce out of cash flow. It means that they're profitable enough to pay dividends, do buybacks, and continue their drilling activities with a slight upward bias without having to borrow money. Those are the 1/3 of the companies that we are interested in. The other 2/3 of the companies, and this is up from 3 companies total, right? The other 2/3 of the companies are little companies, for the most part, or heavily indebted companies, and the little companies don't make much impact, and the heavily indebted bigger companies, they are not having a hard time. They're having a hard time getting money now, right? The banks, Wall Street cracked down on them, and now we have this guy named Jerome Powell who is raising interest rates on them. So they can't, they can't do what they need to do to drill more oil, and they're being forced to be cash flow positive, but they probably can't get there. So what do? What do companies do that can't get cash flow positive on their own, but they have pretty good assets? What do they do? You've just seen about 5 different deals, right? They sell assets or they merge. So we're getting all kinds of consolidation in space. And ultimately, we're going to see about 15 or 20 companies controlling the entire American oil market. And that number was way up around 130 before the crash. I think we're in the 60s right now. You're going to have 20 or 30 companies controlling everything. And if they control everything, what happens when a market is controlled by fewer and fewer and fewer competitors? Price goes up, right? Pricing power, absolutely. And that's what's coming. So what are some of the deals that we have recently seen? I talked, some of the companies in our universe, right? Occidental sold their export facility. We talked about that, why they did that. Generated a bunch of cash. They're selling some other assets. Encana and Newfield just merged. And nobody likes that deal, but I love that deal because they just picked up better assets in Texas, and they picked up some assets in the Bakken. They don't really want to be in the Bakken, so what are they going to do? They've already said they're going to sell those assets as soon as they can get a price. Now, you have major players in the Bakken. You have Conoco, you have Continental Resources, and you have Whiting Petroleum. Whiting Petroleum probably can't buy that asset, but Continental Resources is cash flow positive. I would say that Continental Resources probably picks up some Bakken assets from Encana, right? Maybe Conoco goes out and does it. I'm not positive if Conoco wants to buy anything because their management for the last 4 years has been focused on selling just about everything. They're selling their North Sea assets, Conoco is, right? So a couple of years ago, Conoco said that they're going to stop doing all offshore exploration, which I tried to tell everybody that is a huge harbinger. When a company like ConocoPhillips says we're no longer ever going to do offshore development, and they start getting rid of their rigs. They stop doing their exploration, and now they're selling their North Sea assets. What does that tell you about offshore oil? There's not going to be a lot of development of it, and the reason day rates haven't gone up is because that demand has not developed. Now, I will say, in a few years, you're going to have countries like Guyana and Brazil and Algeria, Nigeria. There's going to be several countries, not many, just several, that are going to do pretty big deep water projects because they are not so deep and they're relatively easy for them to develop right off their shores. And why would they develop that oil off their shores? Two reasons. Even if we get this curve, where did my curve go? Even if this curve is coming, why would they do those developments? What do all those countries have in common? What does Guyana, the African countries, Brazil, what do all these countries have in common? They're developing economies, right? So they want cheap oil. So even though they won't export as much as they hope, and Exxon is helping develop some of this stuff, the price of oil is going to be going down, and these countries will just have cheap oil. And that is what had happened to the United States here with the big upsurge in shale over the last couple of years. We're at 11.4, 11.6 million barrels a day we're drilling. There's this pause in the Permian, which is all over the place. We all know that it's happening because they have a shortage of pipelines that'll last until about the middle of next year and then be alleviated by the end of the year or early in the next year. So from the middle of 2019 to early in 2020, that's when the pipes come online in the Permian and they can just drill as much as they want. But between now and summertime, you have a shortage of pipeline. So this 11.4, 11.6, I have to look again. Let's say 11.6 million barrels per day that we're drilling. That's going to drift upward very, very, very slowly until summer. And then we'll probably get a surge. So between now and summertime, we have to be very opportunistic because this rebound is going to be pretty sharp and pretty big because OPEC, right? Russia plus OPEC is OPEC, are going to cut production by about 1.4 million barrels per day. And I would say that I believe with disruptions and further Iranian sanctions, because there's not going to be any more waivers, maybe for China and India, but the other ones, South Korea, those other waivers are going to go away. We have that chart, right? So these are the countries that got waivers. China's the big one, but even they're taking less. India is the one that really hasn't taken much less. India is going to reduce their take by about half by spring, and China, depending on the deal we do with them on trade, will reduce their take too. And remember, in the back of your head, just always remember, nobody likes the Ayatollah. So if these countries can get oil from somewhere other than Iran, get on the good side of the United States, and support their economies, they'll do it. They don't want the SWIFT system swiftly kicking them in the ass. And all of these vehicles that they're trying to create through Europe to move Iranian oil by playing a shell game, do you really think that we aren't smart enough to say, okay, we know where the oil came from, but because on paper it looks like it came from somewhere else, we're going to let you slide? What did we do with the steel tariffs? China was distributing steel through third parties. We sanctioned them all. We tariffed them all. So whether you agree or disagree with what President Trump is doing, he's doing it. Period. And there are certain things he's not going to back off on. He's not going to back off of Iran. And that brings us all the way back to Saudi Arabia. Saudi Arabia knows that he's not going to back off of Iran. And everybody knows that U.S. production is going to surge in the second half of next year because the Permian will start pumping a lot more oil. It's not going to be until then because there's nowhere to take it. There's no way to get it there. You've seen the pipelines from Canada are a mess. We can't get those built. I'm not really sure if we ever will get XL built. I don't really care if we do. Ultimately, the side of history is for the price of oil to go down in the very long term, but in the short term, it's tied to inflation. And unfortunately, we have a problem coming. And the problem that we have coming is the Federal Reserve. The Federal Reserve is a big, big, big issue. So, and here's the headline that when the demand for oil goes up next year, by the end of the year, we'll be covering most of it, right? And there's a lot of things to think about here, right? Moving parts. The United States is still a net importer of oil. We don't produce enough for us to use. So when Saudi Arabia says we're not going to send you as much, that means that we have to either get it from somewhere else, Canada or Mexico, or we have to figure out a way of refining light sweet crude more efficiently, because most of our refining is heavy sour. And the Saudi Arabians bought either the second largest or largest Gulf refiner for heavy sour. So, do you think they're going to change that plant over to light sweet? No, they're not. A lot of strategic moves here by Saudi Arabia, and we really have almost zero leverage on them anymore, right? They don't need our arms deal. President Trump wants that arms deal, but they don't really need it. They can get their weapons from China or Russia. And I talked about in this article what could happen if Saudi Arabia and China take this juncture to start introducing the yuan to oil trading. What if they cut a deal on weapons and factories and oil and internationalizing the yuan? What if they do that? I think I predicted 2 years ago that it was going to happen, and I put the time frame as late this decade. So I'll find that Market Watch article where I talked about it. But the reality is that the yuan is going to become an international currency. Now, it may only become international to the extent that it's with their trading partners, but almost everybody trades with them. So with the special drawing rights from the IMF already including China now, there is a formula already supported by the IMF for internationalizing the yuan. Well, if China starts buying some of its oil from OPEC in their own currency, maybe 10 or 15% of it in their own currency, what does that do to the petrodollar? That hurts the strength of the dollar, drives the dollar down. In the short run, everybody says, yay, we're going to export more. But wrong, we're not really going to export more. Why? Because supply chains are moving closer to their end customers. Why? Because of artificial intelligence and automation, robots. So the whole disparity between labor costs is going away because less labor is used for manufacturing, which points to how freaking stupid it is that we're using trade policy to try to get supply chains moved here. It doesn't matter. Supply chains are going to move here for our customers. Exports between nations are going to be very dictated by comparative advantage in the future. And because there is going to be robots and automation, there's going to be less comparative advantage because a robot in China costs the same as a robot in America. The United States is a leader in providing services to the rest of the world because we are experts at damn near everything. And by alienating our trade partners, we are creating a situation where we can't export our services, where they're not hiring American companies to do the consulting. So if anybody thinks that what we're doing on trade is smart, I will tell you have it ass backwards. Because we are not living in reality land or future land, right? President Trump and Ross and the other knuckleheads are living in Navarro, are living in look what they did over the last 20 or 30 years land. It's too late. It's done. It's over with. It's gone. The reason that Nixon started trading with the Chinese is because you don't want angry, hungry Chinese. Hungry, cold, angry Chinese. Why would you want that? They're a nuclear power. There's a lot of them. Do you really want to tempt fate? Let them be happy. Let them get fat and stupid like we are. Enough on that rant. Will the global economy slow down enough next year to cut oil demand even further than what is projected now? It could, right? Is it likely? No. It looks like the Trump administration really wants to cut a deal with China. Why? Because they need a victory. They got their clock handed to them in the midterms. They need some victories. And trade is the first thing that they can do. Come January, they have to deal with the Democrats in the House. And there's going to be a periscope of President Trump's financials. So don't expect the political drama to go away. However, they've shelved the talk of impeachment. Why did they do that? Why? Why do you think the Democrats aren't really talking about impeachment except that crazy girl from Puerto Rico or from Puerto Rican girl from New York? And I'll tell you, I don't respect her at all. Not even a little bit. I don't think she knows what she's talking about. I think she's emotional. I don't think she understands anything that's out there. I think she's a kid who ran on a platform of, I'm from the neighborhood, and I understand. It's the same way that Trump won. He went out into the Midwest and said, I understand you. I feel your pain, just like President Clinton did. But why are the Democrats not pushing impeachment all of a sudden? Who's got an idea on that? Because it affects the economy. Not a lot of thought on that, huh? The reason they're not pushing impeachment, and I say this, that's right, they want to work with them. They want to get this infrastructure deal done. Badly. And they know what I've said to you for the last 6 months. Right? I'm not the first guy that hears this stuff. President Trump's okay with Medicare for all. He is. Imagine if he agreed to help prop up Obamacare or even went all the way to the side of Medicare for all. How does he lose in 2020 if he does that? That is his wild card thing. And the Democrats have to, they really have to think it through. Is like, do we want to cut a deal with him on healthcare? Or do you want to run against him in 2020 on healthcare? Right? It's a tough decision. I don't know which way they go on that. So they do want the infrastructure bill there for sure. And I've said there's a possibility that they just fight with each other and they let the economy slide into recession. But if there's a deal with China, that's probably enough for us to avoid a recession by the election in 2020. So we'll see what happens there. And I actually think there's about to be an awful lot of pressure put on the Federal Reserve to the point where I think they might try to fire Chairman Powell if he continues to be hawkish. Why? Because some people understand what I understand is that if the Federal Reserve keeps raising interest rates and tightening liquidity, we end up not having the money that we need to go after commodities, right? Because these companies need to be cash flow positive. And if they can't borrow at cheap rates, then you are in fact causing inflation. So the Federal Reserve is in this weird spot where they don't understand the whole slow growth for everything that I've talked about over and over and over again. They don't understand it. They think that supply side economics works. It never has. It always leads to a crisis. They're apparently going to try it for the third time unless there's some intervention. So we have to watch all of these things. Between now and the first half of next year, I'm not terribly bearish. We got this correction here in October. I've loaded up on technology. I've reloaded on energy. And I think we're going to make a lot of money on both because we found out that buybacks are going to be higher next year because the companies spread the money out from the repatriation and their profits over 2 years instead of one, which was very professional of them. I didn't anticipate that. The C-level people at the profitable companies are pretty smart. Most of them are QQQ stocks, right? There's a hint. Buy QQQ if you want something easy to do with an index. Or, you know, cherry pick 8 or 10 of them. But I wouldn't, I wouldn't carve too much. The only companies in the big companies in QQQ I don't like is I really don't like Facebook or Netflix. I think that Netflix is overvalued given the massive competition coming. And as I said last, I don't know, April, March, whenever it was, I wrote the article. You can still see the headline. You can't read it, though, unless you're a member. And you can read it at Margin of Safety or as a pro member on Seeking Alpha. Facebook's problem is going to cost them a lot of money. What did I say? I said Facebook's going to go down into lower 100s, right? So, let's get off of energy for just a minute. Take a look at Facebook. Not that. This. All right. Put these guys. There you go. How's that for a 1-year chart? $138 today. Oh, wow. How low did I say it would go? In April. And remember, I was a buyer of Facebook when it crashed after the IPO. Why should you remember that? That's close I come to toot my horn. Nah, I toot once in a while. Did I give up? Let's see, where do I have Facebook? Do we have Facebook in our VSL? I don't think so. I don't think we're really following it, are we? Man, I don't even have it on our list of companies that we like. So, there we go. In any case, I'm going to fire out some questions. We'll do just kind of a round robin here. I'm not going to talk about the specific oil companies that we like. I'm going to put out a reminder that folks should be loading up on our favorite Permian companies today and tomorrow. And look, as you can see, I was a little bit upset with my security software. All right, I've been told I'm colorful at the poker table. What do you want to know? Bought some PCG preferred. Do tell, what is that? PCG. What the hell? Why would you do that? Oh. You folks, what do you really know about them? Just because the regulator said they won't let them go into bankruptcy, that doesn't mean that the stock can't go to 5. They just burnt down half of the state. Oh, man. Good. Sell it. Get rid of it. Good trade. Get the hell out. Oh. They thought, yeah, I like all these companies. So people are asking me about certain companies that we've been scaling into, but no, there's just negative technical reasons that the market's going down right now. People are still afraid of uh, the uh, the possibility that the economy slows down. That's all this is. And mom and pop have not been sellers. Retail investors have not been sellers here. People who own index funds and funds, they have not been sellers. It is people who get sucked into trading against the professional traders and who sell when they get scared at the bottom, they get waxed. That story never changes. Stop asking why something went down. It's because the traders have some power. They always have, they always will. When liquidity gets less, they have more power. That's all there is to it. That's why they couldn't push the market down for 8 or 9 years, because there was so much liquidity. Now liquidity is getting back to a more normal level based on history, and they have a little bit more power that from time to time they can push things down. So folks are asking me, well, where's the buyback rally? Without the buybacks, the sell-off probably would have been, we would have been down to 2,200 probably on the S&P 500. Why? Because there's not a lot of buyers out there. We've talked about this several times, right? The institutions are net sellers. Why? Because the institutions are, for the most part, retirement plans. The baby boomers are retiring in bigger and bigger numbers. We're halfway through the baby boomer retirement. So the institutions have to sell to meet their pension obligations. In about 5 to 10 years, there's going to be a pension crisis in this country. Why? Because the pensions are about only 60 to 70% funded. There is a $5 or $6 trillion hole in the pension system. And we're just going to fill it with helicopter money, guaranteed. I will put that as a 99% probability that when we bail out the pensions, it'll be with helicopter money. We're just going to write a check. And then you're going to say, are you issuing bonds for that? No, we're just writing a check. Well, how are you going to cash it? Oh, because we're going to print the money. Or are you going to do QE? No, we're just going to print the money. This is helicopter money. They're going to drop helicopter money into the pension system, and maybe Social Security too. I think Social Security too. Should do Social Security too. Why? Because that money trickles into the economy over 30 years. It is the perfect offset for inflation, or excuse me, for deflation, because you are creating demand push. It won't even be hyperinflationary. All these Austrian guys are like, oh, they do helicopter money, it's going to be hyperinflationary. No, it's not going to be hyperinflationary because the world is deflationary now. Europe is old. China is old. Japan's ancient. We're old. The 4 biggest economies in the world are old, 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 and really old. Actually, we're pretty old. Europe and China are old, and Japan is really old. 4 biggest economies in the world is 70-80% of all GDP. There's no growth. The only growth is what we decide to do on the fiscal side, which is why we need the infrastructure bill. And it needs to be a big infrastructure bill. It should be $2 or $3 or $4 trillion spread over a decade. Smart grid, water infrastructure, desalination, bridges, roads, telecommunications. That's just mainly private, though. So, you know, think in 10 and 20 and 30-year hunks of time, not 10 and 20 and 30 days. Because it'll give you a perspective of where the world is going, where the big headwinds are and where the big tailwinds are. And decide who you're going to vote for in the future based on, do they understand slow growth forever? If your number one issue, actually your number 2 issue, everybody's number 1 issue should be that we not get blown up. My number 2 issue is, do they understand the economy? And then everything else comes after that if the candidates are tied. I don't care about all the other stuff. I really don't. Not if they're going to cause a recession or a depression. Nothing else matters if they do that. So, social issues, healthcare, everything, they're important. But if we blow each other up or we crash the economy, they're not so important anymore. So I start with, are we going to blow the world up? Is somebody going to cause a war? Are they going to crash the economy? And if the two candidates are both pretty good on those issues, then we can go down to healthcare and equal rights and everything else. So, are you still a buyer of USOU? What do you mean by still a buyer of USOU? I mean, if I had brand new money today, would I buy it? Yes, I would. I think that oil is going into the 70s or 80s. I want to own oil through the summertime or till summertime. MLPs, I don't like MLPs. Why don't I like MLPs? There's no longer any growth. Why? We already know that demand for oil is starting to get to the end point. These companies aren't going to spend money on growing. The MLP structure was designed for ever increasing share issuance and debt service based on perpetual oil flows. That growth is gone. The only money to be made in MLPs is if you can find a pricing disparity based on what they spend and what they collect. That's it. Most of those companies are very efficiently priced. You're going to see a slow deterioration in their share price over the next 10 years. Does that mean they can't go up for a year or two? No, they could. It's not a game I want to be in, though, anymore. I talked about that a long time ago. All right, so I'm going to go up a little higher on the list because I'm make sure I didn't skip anything, and I'll work my way back down. Ooh, let's see here. Bloomberg reported positive advancement in trade talks with China. Yeah, we'll see how that goes. And then freaking Secretary Ross, who I'll tell you, that guy is just another real estate guy. And the trick to real estate is to develop and get other people's money and then take your cut first. These guys, we don't have the smartest people running our trade policy. So while I think they should cut a deal, while I think they may want to cut a deal, I think they're hard-headed. I don't think they truly understand the global economy. I don't think they really understand supply chains. I don't. They hired a non-economist for the Federal Reserve. They don't really have any economists in there except Navarro, who's a pretend economist. You know, you can say, well, economists disagree all the time. Yeah, on details. But anybody who's from the Keynesian school or the Chicago school pretty much heads in the same direction. Then you have these idiot Austrians who go the other way. And they, get people to believe in supply side economics. And then they crash the economy and they destroy the middle class. But hey, they're conservative somehow. I don't know how, but somehow. And then people vote for the people who support them. So I don't know. I think it's all a racket. I think it's a big scam. I've called it the big skim. I think that they say one thing and they do another, right? In any case, will we cut a deal with China? I don't know. Senate Republicans will never pass Medicare for all health care. Yeah, I think you're probably right on that. But I do think that they can do some repair on Obamacare. And there's not much repair to be done. I mean, I'll tell you what. My premium this for 2019 is going down 19%. Going all the way back to 2017 pricing. I'm okay with that. How do you like Apple at this price? Num, 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 num. I think it's a pretty good answer, right? If you are a dividend growth investor and you're not buying Apple down here, you're not really a dividend growth investor. How's that? Look at that support. Came up to new. Yeah, Awfully hard not to buy it down here at the 200-day moving average. Now, the thing to understand about Apple is that the growth will no longer be in the cell phones. The growth is going to be in everything else. And I'm telling you, young people like their stuff. My daughter uses it. All her friends use it. If you're a college kid, you're using it. And the services that they have are going to be amazing. So folks who are embedded in the Apple infrastructure, as that infrastructure grows to include smart car technology, smart home technology, more and more entertainment, right? They're going to offset what they're not making on the hardware eventually. And remember, people replace their phones every 2 to 3 years. Now, it was 1.7 every 1.7 years. Now it's 2.3 or whatever it is. And sure, I mean, I hold my phone close to 3 years usually just because I'm too lazy to go get a new one. And, you know, it's nice to not have that $25 a month payment for a while. But, you know, people are still going to replace those phones. So you're not going to see iPhone demand go down. It's just not really going to grow anymore. You know, just a little bit, 2, 3, 4, 5% a year. NVIDIA. Ooh, that's a good one. Somebody asked me about NVIDIA here, right? And what did I say? NVIDIA. NVDA. Did I say 140? All right. There you go. 125-ish that we talked about for NVIDIA. That was my price target. So let's go take a look at NVIDIA. NVIDIA. They're down to 166 from whatever that was, 290. Down to 166 today. Does 125 look so far-fetched anymore? See, this is it. This is important. Bump, resistance, breaks through, stays above it. 125 makes a lot of sense to me. 125, 130. And then you sell puts on it. Let's talk about selling puts real quick, just since we're on the topic, because I brought it up. People with small accounts should not be selling puts. If you don't have $50, $60, $70, $80,000, you shouldn't even be thinking about selling puts because it screws up your asset allocation because you got to buy it in 100-share lots. So when you sell one put, and if its stock gets put to you, you're going to get 100 shares. So really, if you have a 5-figure account, it's okay if you want to swing trade a little bit, if you understand technical analysis and quantitative analysis. But as far as selling puts, you have to mind your asset allocation. So if you have a 5-figure account, you're probably not selling puts. So just keep that in mind. Selling puts is for people with 6- and 7-figure accounts that want to generate meaningful income and average in and out of positions over an extended period of time. And I talk about scaling in and out all the time, and people seem to think that means over a few days. No, over months. Why? Because we're not good enough to time the market to the point where we can catch bottoms all the time. As I've said, we do catch bottoms, but it's because we buy 3 times or 4 times, right? Or we end up getting a very good cost adjusted basis because we buy once, then we sell puts twice, and all of a sudden we're like, our cost base is actually at the low because the price went up and when our puts didn't get put to us. Now, some of our puts are going to get put to us soon, especially in energy if this rally doesn't occur by January, but so what? If you're selling puts, you want the stock. You're building a position. If you're selling puts because you just think it's free money, you're wrong. Get over yourself if you think that you're that good at it. Somebody asked about the swing trading service that I'm opening at the end of the year. I don't want you in that service unless you understand technical analysis or quantitative analysis. If you can't read a chart and you can't size your positions properly, right? I'm not going to teach you how to swing trade to the extent I've been teaching people some other things here. You have to come in armed with some technical knowledge or some quantitative knowledge. Now, I will sell the classes, and in fact, I'm not going to do it myself. I have found the classes for you to take, and I'll be selling those on the updated fundamental trends. But I don't want you to think that you're a swing trader just because you want to be a swing trader. You better take the time to learn technical analysis or quantitative analysis. I really think that those of you with some programming history, get into some Python and some algorithm building, that's where you're going to really come to appreciate cash flow analysis. So anyway, moving down the list. The buybacks are happening again. The buybacks are happening. Just have some negative momentum in the market from the traders. There's some fear right now. But really, the mom and pop investors are not selling. We are not seeing big outflows. So that means that things are probably going to turn around soon. I am new to your service. What are your thoughts on IBM long term? Well, welcome to the service. And we just talked about midstream. I don't like it. I think that their business model is near the end. And eventually they're going to have to figure out what to do with empty oil pipes. Do they abandon them? I don't know, 20 years, 30 years from now? I have no idea. IBM. IBM has great technology, right? The problem with IBM is that it's a mess. Way down at 121. So I had an executive, somebody who had been an executive, middle management, up bottom executive at IBM 15 years ago. And we bought, maybe it was only 10 years ago. Yeah, that's probably more like it. So I remember buying the stock in the 80s. And I sold it right in here, around 160. We doubled our money. She got mad at me because it ended up going up here. Look at that triple top. Boom, boom, boom. And it's been coming down ever since. Big drops like this are usually precursors to more decline, right? Unless it's commodity driven. But this is an indication that the business is unhealthy. So you take a look here and you say, okay, at what point would I want to buy IBM? Well, the price to book value, you probably need to adjust that for something because that looks a little bit out of line. Debt to equity, right? That's real high. No real growth. I think that IBM probably goes under 100. Let's see. Look, here you go. This is probably where you get to on IBM, 90s, 80s at some point. And then you have to evaluate the business from there. And you break it apart piece by piece. Their artificial intelligence is good. Their nanotechnology is good. Do they really have anything that stands out as completely better than the competition? And I think that's a question that smarter people than I are going to have to help us with. But I don't know that they have anything that's significantly better than the competition. But I do think it goes into double digits again. When the Permian pipeline comes on this summer and into the autumn, will we sell our assets and re-enter at lower prices? I think that if the pricing goes the way I think it's going to go, right? If I think that these companies are going to keep churning out money, we stay with oil as long as the price of oil is staying up. Now, USO, I gave people 3 spots to sell USOU the last time we did it. I don't know. I know that some people didn't sell. Too hard to put in limit orders, I guess. But, I got out of mine in the 70s and at 90 at the top. 90. I think it went a little higher than that. So oil is a trade. Oil stocks, some of the oil stocks we have are investments. A couple of the oil stocks we have are trades. Continental Resources is a trade. But Encana, which I've been public about, I think we hold that until they go through more M&A. I think that we hold on to Occidental very long term. There's a company that's going to be spitting out income and have growth for a long time because they're cash flow positive, and they have the carbon mitigation, which is going to be a big deal. Centennial Resources, I think that one probably doubles or triples, so we have to wait for that. They have a great balance sheet, and Pioneer Resources too. So we have focused on companies that are basically Permian plays that once the pipelines are built, understand this, that actually raises the price of Permian oil, right? Think about that. Why would that happen? Because now they can get their oil to the market. So while WTI might come down $5, Permian oil might go up $5. So we're focused on Permian oil. We're bottom fishing right now on all this stuff. So we'll have to play it by ear. Now, can we trade around our core positions? For sure. Will we be selling our leverage, right? Will we be closing our leverage, closing our leaps? For sure. But I don't know that we get completely out of oil stocks right away. But right, there does need to be an exit plan because we know that long-term oil has a problem, and it'll have a problem, when the next recession starts too. And we don't have to anticipate the next recession. Just when it starts, we'll know, and that's when we sell because it'll top out. Oil's like the last thing that goes down because it usually helps cause a recession. Semiconductors. We talked about NVIDIA. I think XSD we need to hold off on for a little while. QQQ I think you can buy because it's not that heavy in semiconductors. Yeah. I mean, I don't see 40s coming on XSD. But, what's that price right there? 61-ish, 62-ish. Yeah, I'd have to take a look and see what our bottom fishing is on that. What is our bottom fishing on this? Do you know the bottom fishing on XSD? Is it right around 62? So we have all these. So if you're not a subscriber, look, I understand that about a quarter of you are going to subscribe, steal all the information, and then, stop paying. And all I can tell you is that good luck to you. Right? That's all I say. Good luck. XSD 62. Yeah. Look at a chart. Magic. All right. I still love Sierra Wireless. Calix, remember, that's a home run one. So it's up 30%-ish for us, Calix. You might want to take a little bit of profit. Time to sell Verizon. Good Lord. I think that's a breakout, man. I told you all these telecom stocks were going to break out. Fundamental chart. Let's throw a T on there. Throw a CTL on there. We'll run through this one more time. Fry's is probably winning right now, right? Well, CenturyLink was winning. It'll start winning again. That's a good trend, man. Look at that trend. AT&T has to catch that trend. And CTL, man, look at that. Doom, 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 doom. That's unhealthy. That looks like it's starting to catch its wind. So with all of these companies with the 5G, these three big companies have all taken different strategies. That's why I want to be in all of them. I don't know which one's going to win. I have a suspicion. The AT&T, which is the most integrated company, is going to do well. I think that Verizon is going to partner up with somebody at some point on content. But if they just end up being a pipe company, there's a reason why the companies delivering your internet can do very, very well, and your wireless, right? They can be a more pure play. CenturyLink is enterprise, but they also have this gigantic network, 126 countries or something. Could you imagine T-Mobile, the new T-Mobile, merging with CenturyLink? 5G needs that backbone. Also, T-Mobile would be a monster at that point, right? Or what if Google decided to spin off their fiber and start a wireless company, right? There's a lot of reasons that these three companies, you just buy them as a basket. You make them 6% of your portfolio, give or take, maybe 8 or 9, and you just collect the dividends and see where this industry goes now that it's consolidated and the world is using more and more and more and more of their services. That's what I think. I think that these are great companies for dividend growth investors to have, a high single-digit percentage of their money in as a group. Yeah, Qualcomm just got smashed again too, right? Oops. Yeah, interesting, right? Gets that nice big rebound. I think we're getting a second chance on Qualcomm. Kind of like it. Kind of like it. Fat dividend, 5G technology. Their patents are a big deal, right? So ultimately, there's resolution with Apple. This is pricing in bad Apple resolution. This is pricing in good Apple resolution. Well, if we can get the bad Apple resolution price, and even if it goes somewhere in the middle, ultimately you have all their technology patents going to drive them up as more and more of those patents get used. All right. I believe MDR. Yeah, people keep bringing up MDR. I ran into them first way back in 2012, and they just have never seemed exciting to me. Yeah, that's not exciting to me. This is where I discovered them, right in here. Yeah, just not exciting. Not exciting. EWO Mexico. Yeah, slow drift down, right? Eventually, it's got to turn into a nice rise up. Not sure. You know, I think it makes sense, but the trend is not our friend. And I've been becoming more trendy lately. My girlfriend bought me some new pants, said I look nice. Right. All right. You can nibble on Mexico, but don't take a big bite. What is your opinion of LNG? Trump, 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 Trump trade. Trump trade. Right? Is that what it is? Trump trade. I think that LNG is the future of natural gas transportation. I think we're going to see a lot of it. And Cheniere in particular, I have not analyzed them in a long time. That's a pretty good trend. This is a pretty good pullback. They're not paying a dividend right now. Well, I didn't know that. Did they get rid of their dividend, or did they just not have one ever? I'm not really sure. I would not buy a financial company if my life depended on it. Somebody's asked me about Lazard a couple times. No, I don't want any of these mutual fund based companies. If you want to invest in here, let's pull up one of my screens. And let's go by industry. Oops, that's not it. Industry. All right, good enough. Global banks. Pretty much X across the board. I don't like JP Morgan Chase just because I don't think interest rates are going to go up much higher. And every now and then they have a big blow up. I don't like Bank of America because I think the next recession hurts them badly. I only want to buy these banks off of major corrections. Okay. There's a couple of these regional banks that are all right. What do they call Lazard? What industry is Lazard in? What do they call them? Are they not in the... They are not in the S&P 500. I didn't know that. Okay. In general, no, I don't like the money managers. Pretty simple. I think that anybody who's tied to mutual funds is going to have a problem that gets bigger and bigger and bigger over time. What is the symbol for Lazard? LGI? This one? Oh no, LAZ. There you go. Yeah. No growth. A no growth company with debt. Trading at price to book of 4.2. Financial companies should be trading at price to book of like 2. So these guys can come down 40, 50%. 21, just a couple years ago. Low 20s during the crisis. Yeah, these guys for sure can get under 30. Bah, no growth. No growth. Bah, no growth. I didn't say I believe that Calyx is a home run. I said that it could be a home run because they have a component that Verizon uses for their 5G build out, and CenturyLink has started to use them too. So they could be a company that all of a sudden goes from producing a little bit of stuff to producing a lot of bit of stuff. Read the reports. Start there. All right. I think that we are done for the day. I'm going to go try to become the Wisconsin State poker champ and will probably fail. But that's okay. My buddy came in 40th in his flight yesterday, so all I have to do is bag my chips at the end of the night, and then I can lord it over him. All right, you guys have a great time. Buy oil stocks. You know which ones. Get up to your full allocation there. All right, take it easy, guys.